All right. I think we have Vikash Jain also with us. Let me actually start off that conversation. He's joining us this morning. And, from CLSA. Vikash, great to have you with us. Lots to discuss, of course, given the current, market environment and really what to keep an eye on as we sort of move on in 2021. We're starting off with record high valuations, of course, and continuing to see those incredibly strong flows. From a strategy point of view, where are we then? Is this still a good time to get into the markets? Are you awaiting some kind of necessary correction? Do you anticipate a much higher move from here on? How are you viewing things as they stand right now?
So the way we would look at this is valuations are definitely not supportive. It's not just about India, it's how pervasive expensive valuations are. So in our very recent report where we gave out the outlook for 2021, we looked at global markets, and 8 out of some top 19 markets are trading very near their all-time high valuations. And this is a total of about 55% of global market capitalization. So it's not just about India. It's a theme which is there across the world. In case of India, historically, if we were to look at forward PEs, 16.5 to say 19.5 times has historically been around the place where markets have kind of formed a significant peak followed by reasonable corrections. We are much higher than that right now. We are like over 21x. Even if I were to use FY22 earnings, that is earnings which have no impact of lockdown. So completely ignoring FY21. Historically, if we've ever invested above 18x, we have never got any positive return on the index either for 1 or 2 years. So I would say from a perspective of valuation, this is not supportive. If anything, the trade is not on the index. It is in individual stocks. So if we look at individual stocks, what's really the theme which has driven the market? So that theme has to really play out. There's an anticipation of economic recovery and economic normalization. And that theme has to really play out for the market to continue rising. So I think that's stocks linked to that theme is what you need. If you're bullish, that's the theme that you need to look at playing if you want to be bullish on the market.
Okay, just to sort of probe that a little further as well, and I'm also looking at the kind of picks you have going in for 2021, and it's I think it's not so much sectoral as it is perhaps selective and across sectors, whether it be, I can see real estate, telecom, financials. So is that the approach that you're taking, perhaps leaders within the pack, on a very growth-oriented basis vis-a-vis certain pockets of the market that you think may do better?
Yeah, so I think the approach is that it's a mix of, there are, I would say the majority of the stocks are nearly, half or little less than half are stocks linked to domestic economic recovery. And within that, it's really some stocks which give me valuation comfort as well. And there is a possibility of a perception change on the stock. So those are really the kind of stocks that we've picked up. And in addition to that, we also have some kind of global defensive names as well, and some domestic defensive names. So it's really a combination of the two. It's really very bottom up, like I told you, that this is going to be the year where you really go into stock picking. Rather than playing any broader index or the theme. So that's how I think we've approached stock selection within that report.
Because morning, Nikunj also joining in. While there is evidence that if you bought into Nifty when the P multiples have been 18 times plus, the future returns have been very different. But if I may just contest that with a very different argument, which is that interest rates are low. This is for the first time we are on a cusp of an earnings GDP cycle. And if earnings and if growth and if momentum surprises us, P multiples could easily expand because inflation is also different.
Hi, Nikunj. So the way I would look at this is, one of the key themes of the report is the reason why people are more excited about India. Like, for example, last year, India was the only major emerging market, if you were to look at most markets except China, where we saw significant FII inflows. All other markets saw outflow. We actually had the third best year of about $23 billion of FII inflow. One of the reasons why people are more interested in India is, if I were to look at, again, all top global markets, India is the only market, or of the two markets which have doubling of earnings over 3 years. So from 2019, which is calendar year, which is the pre-COVID year, to 2022, which is FY22, FY23 for India, India's earnings are nearly doubling. That is Nifty's earnings. Now, that's what is causing a lot of excitement. The problem that I have with that, the history of sell-side consensus, that is my community, in predicting Nifty's earnings isn't really a great one. We've had 6 years of downgrades before we saw a small upgrade last quarter. In fact, if I were to go back to FY19 and FY18, sitting in January to the time the actual earnings came, there were downgrades of over 20%. That history doesn't give us a lot of comfort. The other way to look at that is that simply earnings growth has to be delivered. I think that argument will be tested over the next 3 months. We are celebrating significant improvement, that we see in various economic indicators on a YOY comparison. But the point that I highlight is January and February, and to an extent December, is a stiffer base. Because if you recall, year 2019, there was already a slowdown that we were seeing in the last few months of the year. And things picked up in early 2020 before we went into a lockdown. Anyways, from March, we will not be looking YOY, but we'll be looking how it was 2 years back because of the lockdown. So I think Jan, Feb, March, from that perspective, would be real test of whether this recovery really continues even on a stiffer base. So that's really what, that's something that we will need to watch out for, because I am reasonably nervous that the rally is based on growth, this earnings growth being delivered, which is, doubling of earnings in 3 years for Nifty, and whether this will play out, because historically we've seen several downgrades when these expectations have been there.
Important theme where again we've had a consensus view from sell side for last couple of years, which is that capex will start. That's point number 11 in your report. What are your thoughts on capex? When I hear from a company like Ultratech followed by Hindalco, and when they are talking about positive things about spending money, followed by a comment from Adani, is there reason to be optimistic that corporates, at least the big corporates who are capable, would be starting a new cycle, new spending cycle?
See, there's of course reason to be optimistic in the sense that if you see what is the positive? The positive was clear that in a pandemic year, we've seen our credit costs for the banks being extremely manageable. We've not seen any big corporates faltering and on debt, and so a large part of the corporate debt cycle problem is possibly behind us. So that allows them to think about some kind of balance sheet expansion. However, there could be incremental positives, but the big pickup may still not happen this year, because if I were to look at many of the big sectors, their utilization levels are still quite manageable for them to think about capex immediately. So I would say, yes, a start would happen, but something which is a big pickup and a whole capex cycle coming back is still some time away, in my opinion.
So because let's divide the market into 2 or 3 components. One are the structural compounders, where they are headed. B, what are the new themes you've identified? And what are the businesses where for next 1 to 3 years you expect a cyclical recovery or an earnings recovery or a market share gain?
So, I think the market share gain theme itself is across, sectors. For example, it has played out in telecom, it's continuing to play out. In banks itself, if you were to look at the top 4 or 5 banks, the market share gains that they have on the incremental loans is something which is an incremental deposits is something which is continuing to play out. So market share gain theme is present. I think it's really which started with GST, demon and all of that, and has continued to strengthen through the pandemic. So that's something which is there. If you were to look at real estate again, Again, the bigger players are benefiting at the cost of the smaller ones. All of that. So essentially, the survival of the fittest and the strongest is something which is playing out across, sectors. So that's a theme which continues, in my opinion, unless we see a significant economic recovery to take place. Even for this year, we're just seeing that possibly we'll go back to 2019. If we're surprised on the economic recovery bit is when I think interest in the smaller players could kind of pick up, if some of them still have the balance sheet strength to take it forward. But largely, I would say that market share gain themes continues to play out. If I were to look at the kind of themes, so there are certain themes which continue, which will see a significant fillip despite we trying to be more normal after hopefully the COVID cases subsiding, is, for example, the IT theme. Now, there, the requirement for people to move on to, cloud and a lot of other things, the importance of those, those contracts, and that's the sector which is seeing the strongest demand, outlook very clearly. For example, even the commentary which came out after the last quarter, many other sectors were uncertain of how much was the demand which was bunched up and how much was a real ongoing demand. But IT was pretty clear, and that's a commentary which has continued, even, first of the results that we've seen here. So from a perspective of clarity of demand, I think, so that's one theme which continues to benefit. Within FMCG, health and hygiene is another theme which will possibly see a strong, move. So those are some of the themes which possibly continue. I think what has happened, for example, within real estate, the benefit for the stronger players and that whole consolidation theme will be catapulted after the problem that we saw during the lockdown and the pandemic. So some of those themes continue. So it's really consolidators. It's really some of the themes which benefit because of the way our perception has changed about what is required after COVID, which is, for example, IT, and health and hygiene, which kind of benefits some of FMCG plays and some parts of the portfolio, as well as maybe pharma to some extent.
Just going by the reports talking about a strong show likely for domestic plays, you're of the view that metals, cement, healthcare, they're going to see very strong growth when it comes to the PBT performance. Just walk us through your rationale and tell us why you think that nearly 70% of the companies are going to see a strong, healthy YOY profit growth.
Yeah, so this is talking about this particular quarter. So to an extent, we need to ask that, how much of this is baked in? We cannot forget the fact that last quarter, which was largely backed on the commentary from companies, Nifty had one of the best quarter, about 25%, return in one quarter. So this is something which was to an extent expected. It was part of the commentary which came out last quarter that October to December quarter will be a strong one. So essentially, this is a quarterly preview note that we are talking about. So the question, I would say the more important thing will be for further significant returns on the Nifty from here on is not just delivery on these numbers, but the commentary beyond on how much comfort. Like I said, that there was this lack of clarity on how much of the demand was bunched up ahead of the festive season and, because we were in a kind of a lockdown before that quarter. So how much of that is continuing demand? And that's something that commentary will matter much more than just the pure quarterly numbers. For example, certain numbers that you might have seen even for the first few reporting, results, very strong numbers. But I mean, the reactions may not be as strong as it would have happened in otherwise. So it's really not just delivery on that numbers, but the comfort that one gets on the future commentary. That's something which will matter much more. On domestic plays, yes, it is actually going to be, if I were to look at domestic plays now, when I say domestic plays, is domestic plays, ex-financials, it doesn't include the commodity sectors like oil and gas, steel, and all few global commodity sectors. So pure domestic plays, this will be one of the strongest quarterly, performances on PBT. But one of the reasons for that is also because we're seeing a reduction in telecom losses. And that's what is causing PBT, growth to be much better. So I think from that perspective, yes, the quarter is going to be strong. The important thing is, what about the commentary? And will it be the second quarter? And we've not seen too many instances of two continuous quarters of upgrade, Nifty EPS upgrades. Will that really happen?
And with a lot of headway, Vikash, being made, with the privatization plans from the government, the divestment, what's your view on the PSU pack, given that they're trading at big valuation discounts?
So I think one commendable thing which happened last year is finally the government understood that the ETF strategy that they were following wasn't really the best one when it comes to stock performance. And that's one of the reasons where there was a perennial overhang on these stocks that sooner or later there's going to be more supply and that supply is going to come at a discount. So the fact that we've not seen any ETF from the government during this fiscal at a time when the government was clearly pressured for increasing revenues is clearly very encouraging. So I would say from that perspective, the right step has been taken for a big overhang to be taken away from PSUs. The one thing that I kind of would bring out is, although I say that Nifty is very expensive, there are about 30% of Nifty's constituents which are trading at over 10% discount to their own historical multiples. That is dominated by two kinds of companies. One is PSU names. The other is names which have ESG concerns. Now, ESG concern is something which is, where it is more difficult, where, this will take their own time for a lot of foreigners to be able to, only when the ESG ratings are upgraded, can they be, can their funds allow them to invest in some of those names. But PSUs, if the privatization happened, if the government there is some talk of government looking to monetize non-core assets rather than sell shares at a discount on an ongoing basis, if there is more action around that, then there could be further incremental positives for PSUs. And there are certain power names particularly, which we like within that PSU space.
Okay. Vikash, talking about earnings, some pockets like IT, we weren't really expecting too many speed bumps. Where will you really be, focusing to see whether or not we're actually on path for the economic recovery? I mean, financials are likely to be sensitive. Where else would you be focusing your attention this season?
So, there's one theme, since you are talking about that note, I think there is this theme about earnings growth, and where I try and do a little bit of a drill down on where is exactly. So India is the second best earnings growth story after Korea, but Korea started 2019 with a big decline in profit, and on that base they are rising. But where is India's earnings growth coming from? And the point that I highlight over there is that top three names, that is, top two one of the, the top two private banks and also the biggest name in the country, those contribute nearly 70% of the incremental earnings growth coming from. So, those actually do not have more than 1/4 weight in the Nifty, but they contribute 70% on the incremental earnings growth. So it's really those places that we need to look at, whether the delivery which happens is in line with those expectations. So, those really are the 3 or 4 or 5 names along with the IT names where we need to look at. But, so they are the biggest contributors. They need to deliver on this number.
Right. Vikash, what about broader markets? It's something we haven't touched upon, and you have talked about, of course, being incredibly stock selective. But, when I take a look at the portfolio picks here, is that simply a little risk averse, or do you see the momentum a little slower when it comes to the mid-cap part of the market?
Honestly, I would say that, like you identified even, when you talked about it a little while back, that it's a very bottom-up portfolio rather than trying to play a particular theme. I have to be open that I'm a little nervous on the expectations bit. The expectations bit in the sense that we're going after, very strong commentary, the delivery on that. So essentially, I would only want to be more aggressive if we see Jan, Feb, March kind of indicators, really surprising on these high expectations, and we not seeing big earnings downgrades. I have reasonable aggressiveness in some ways, but it's more balanced in terms of the portfolio. So I would say that's the approach that one needs to take. Yes, the markets could rally much more and pay less heed to valuations. In fact, in many of our conversations, valuation is not even coming as a big concern. And I don't know if that's a symptom of a typical bull market and, towards the end of the trend where you want to completely ignore valuations. So it's really the delivery. Where will the disappointment happen? The disappointment. So, this year could very well be, in a way, dichotomous like last year, where the economy was languishing, but the market was doing well. Here, the economy picks up, but maybe at a slower pace than where the expectations are, and the market doesn't do that well. So, it could be just that mean reversion that we see that could be a little bit of a reverse from last year.